Allow me to welcome you to the last Saturday of the year, 2022. Tomorrow is the new year, so in advance, I'd say I wish you a happy new year and a prosperous 2023. Okay, if you've made it this far, congratulations. Whether you're in good health or not in good health, as long as you're still breathing, congratulations. And God, the Lord tarries, we are going to see the end of 2023. And hopefully, it's going to be a better year than this one. Like I said last week, I was going to show you what my portfolio is, the way my portfolio is set up for next year. Now, it is subject to change because we have to adapt to the market situation. But if the market continues as it is, then I'm going to leave the configuration of my portfolio as it is. But if it doesn't and it changes, then I'm going to have to change it. Again, without wasting too much time, I'll try to keep it as short as possible, and let's get straight into it. So the first one I'm going to show you here is how my portfolio is lined up. The first stock you're going to see there is Google. Like I said in my previous videos, that I have one option contract position for Google and two option contract positions for SPXU, which is the one you see on the fourth line there. Now, the SH is the one I just bought recently. You can see the expiry date is 19th of January 2024. I only bought that as an addendum to what I have now, but I didn't buy the full thing for 1,600 plus. I only bought the call option, and the call option I think cost me about, if I'm not mistaken, 100 and something or 200 and something. Pretty cheap, it's less than 300 that I bought it for anyway. And I'm trading lips. What I'm doing with that one is I'm trading lips. But let's not get too far ahead of ourselves. Now let's come back to Google. So I bought Google when it was 118.75. You can see it has come down to 89.05, which is what I expected. Okay, I wasn't surprised. We all knew we're in a bear market, but instead of staying on the sidelines and not doing anything, I have to keep trading. Okay, the more trades you make, the more you learn. You can't sit out for a whole year. When you hear multimillionaires and billionaires saying they're sitting out to preserve their portfolio, yeah, that's understandable because they've made it to the top. Those of us that are still building, we can't just sit out. We can't sit out some portion, which I'll show you in the end, but you still have to stay engaged. Dollar cost averaging or euro cost averaging will be a very popular strategy that they promote, and they say, if you do that, you will be far ahead of the others. But that's for a passive investor. For active investors, you have to do something else. So Google right there is, I have 100 shares of that, and I sold an option contract, which is the next line down. You see the value that's left on the option contract there is 22. We've spoken about the SH a little bit. SPXU, I have 200 shares of that, and I'm selling option. The current value is 1,680. Now, this was taken a few days ago, not today. The prices today is a little bit different. Google has still today, I think, is 86. So it has come down a little bit again, but then I'll show you the reverse of what's happening. So the SPXU, the second to the last line there is the call position that I have for the SPXU, and the 22 you see just on the side of it in red is the current value of that, or was the current value of that position. Forget the WBD. I don't even know what that means. I think my brokerage just gave that to me as a bonus or as a gift or something. I don't know why that one is there, but it's less than one share anyway, 0.98 shares. So I don't bother with that. Look at it. Just look at the 1 day line there, which is under the day trend. If you look at the tab on top, you have position, day trend, and price. The day trend right under it, you see Google going up and making a kind of curve coming back down. This is a 1 day chart that it just give you a quick brief of what it looks like. And you can see SPXU there. It's almost the mirror image of Google. So while Google was going up and then making a curve to either flatline or come down, you see SPXU was going down, and then it was also making a curve to either flatline or go back up. Now you can see Google here has come down to 88. It was 89 in the previous screen. And you can see here it has come down to 88. So Google is trending downwards here. And you can see SPXU is trending upwards here. And the value of SPXU has gone to 1745. And in the previous screen, I think it was 1680 or something like that. And this is basically what I'm talking about, that my portfolio is set up such that it's in a net neutral position. When Google is falling, SPXU is kind of counterbalancing that effect. And I told you before that the reason I have Google as opposed to the Google is because that's the only thing I could afford. I can't afford the SPY just yet. So most of the indexes tend to move the same way. The Dow or Dow Jones, DJIA tend to move the same way. S&P 500 or the SPY moves the same way. IVW, DVY, IWM, the Russell 2000, the Russell 1000, they all tend to kind of move the same way. So while one is going up, they all will be going up, but at different percentages, so to speak. And when they're coming down, they all tend to be coming down. So they're all images of each other. Now, taking you to the next screen. If you look at this screen, is the screenshot of the S&P 500. The S&P 500 is a one-year chart for 2022. And you can see from January, it has made its way all the way down from 460 to 381, which is quite a substantial amount. Okay, so you can see there that S&P 500 is trending downwards. The next screen I'm going to show you, which is the SH. This is the inverse ETF for the S&P 500. So as you can see, it is trending up. It's also a one-year chart. And as you can see, it's trending up from, it was 14, it was less than 14 this year, at the beginning of this year. And it's right now it's at 16. Yeah, it did go up to 17 and even beyond at some stage, close to 18, and it's come back down to 16. But as you can see, generally speaking, it's trending upwards, and that's the SH inverse ETF. The next one I'm going to show you is the SPXU, which is the one I have right now. Now, if you see it, it's almost the same image. I'm going to show you another picture where I overlay both of them side by side, or one on top of the other, just so you see a visual comparison or graphical comparison. You can see this one is trending upwards as well, but the difference is it is moving um, way far more than SH is moving, and that's because the SPXU is a leveraged ETF, leveraged inverse ETF. So it tends to move way more than the SH. The reason I'm using the SPXU as opposed to the SH is because Google, when it moves up faster than the S&P 500, and when it moves down faster than the S&P 500. So I needed an inverse ETF that would be like the SH, which is the unleveraged S&P 500, inverse of the S&P 500, but leveraged so that it moves fast as well. Now, the ratios of that were a bit difficult to calculate, but look, it's doing the job anyway. So right here, I'm going to show you the screenshot for Google. As you can see, Google is also trending down, and you see it moves way more than the S&P 500. Okay, all the way from 150, it's come down to 89. And I think, like I said, today it is 86 or something, like 86 something or something like that. And that is Google trending downwards for the year. Now, if I do a comparison of the Google and S&P 500, you see here they both trending down. And that was what I was telling you in my previous videos, that Google mimics the S&P 500 because it's one of the top 10 companies in the S&P 500. It has a lot of influence on it. The other ones are like Apple, Amazon, Tesla, etc. They're all trending the same direction. Just so you see, here's a comparison for the two, just so you see that they're moving in the same direction. Now, this slide right here is the inverse S&P 500, which is the SH, that's the one at the bottom, and the SPXU is the one on top, which is the leveraged inverse ETF. You can see they're both identical, moving in the exact same direction, but the leveraged one, which is the one on top, SPXU, is moving at a way more radical pace than the SH. You can see that it's right there, it's 1701, and the SH is 1605. And this is why I chose the SPXU, and I got two option contracts, because it's way cheaper than, it's more expensive, although, than the SH, but it moves faster than the SH. Now, there are drawdowns to it, which I won't want to go into in this video, but there are drawbacks to that as well. The In this slide here, you see that is the S&P 500 coming down, and that is the SH you see going up. So this is just to show you the relationship between the no, actually, no, sorry, that's not the S&P. That is Google on top. The one on top there is Google, and the one at the bottom is the SH. So you see Google is coming down, SH is going up. I just put them besides it on top of each other here, just so you can easily see the relationship between the two. And that moves me on to the next slide, the second to the last one. Now, these are the exact inverse ETFs. If you look, the one on top is the SPY, which is an ETF that mimics the S&P 500. I showed you that one before. And the one at the bottom is the inverse ETF. And as you can see, they are exact mirror opposites of each other. And this is what generally what I try to do in a bear market. When the market is in a downward trajectory or in a bear market, what I do is I switch my position to an inverse ETF, and as you can see, the inverse ETF is moving upwards. So when the when the whole market is collapsing and people are screaming over the rooftops, I'm not screaming. I just switch positions, and this is why I tell people that education is key. Once you know what to do, you won't be that scared. I mean, there's a saying I heard once that the people in Titanic did not die in the Titanic because the ship hit the iceberg and capsized. They died because there was no contingency enough for everybody on board. This then leads me to the last slide, which I said will give you a hint of what my portfolio looks like. And you can from here know exactly how much I have in my portfolio. If you've been paying attention to maths in school, you should be able to do the maths here. If you have not been paying, after I explain what this chart, pie chart looks like, and if you have not been paying attention to school, well, this is the part where I said, we told you to listen to your teachers, but you didn't. Now you can't do the maths. Okay, forget about that. Okay, that's just me messing around. So as you can see, my portfolio here, almost 70% of it is in a long position. Which long means the stocks you own, okay, which means I own stocks outright, like Google, SPXU, and the SH. In total, that's 70% of my portfolio that is in a long position. Now, I have 28.78% in cash. What I intend to do is increase that cash for the whole year next year. If the market doesn't change, like I said, if it keeps going the way it is going, my portfolio is a net neutral position, and all I'm doing is adding cash onto it next year. And I keep selling the calls for the weekly income on the portfolio, so to keep adding cash onto it as well. Now, the short options you see there, or the long options you see there, is the SH that I bought. So I bought SH, like I said, I bought a call position, not the SH itself. And what that I'm trading leaps on that. So I bought, the expiry date for that is in January 2025. And what happens is I bought it for about $180 or so. So when for every $1 move in the inverse ETF, which is SH, for every $1 move up or down, I think my position right here, the delta there is 50 cents. So for every $1 move up or down, this long option right here is going to be moving, the call option is going to be moving 50 cents up or down. So it's kind of going in the direction of the inverse ETF. It's a way of buying the inverse ETF without spending a lot of money buying the inverse ETF. You spend a fraction. So instead of buying it for 1,600 or something, I spent about 180 or so to buy it, I think. But I know it's less than 300 for sure. The short option you see there, the one that's 0.7%, that's the positions that I have open as far as the options. So the options that I have sold that are going to expire on Friday, they are the ones that are 0.7% of my total stock portfolio. So, ladies and gentlemen, there you have it. That's where I leave it for today. I know it's been a long-winded video, but I had to do it the way I had to do it. I've never shown my screen, or I think I showed my screen once, but just wanted to take you through what my portfolio looks like for next year. So leave it you here in the able hands of God, the ether, the universe, nature, whatever it is you believe in. I leave you in the able hands of those, and I will see you after the new year.